There was some very unusual activity in the options market today. Now, even if you have no experience with stock options, don't worry. We're going to take you through this step by step, and we're going to show you what today's trading really means. Now, today, there was a very large number of options traded on the VIX. What's the VIX? The VIX is a volatility index. It's also known as the fear index. It's calculated by measuring the option premiums on the S&P 500. And very simply, when that goes down, the VIX tends to rise. The VIX moves opposite to the stock markets. Left-hand side, S&P 500. Right-hand side, that's the VIX. We can see stock market's been weak over the past couple days. Same period of time, the VIX is going up. Now, this is the time and sales for the VIX options. And don't worry, we're going to take you through this step by step. It's actually very, very easy. Right here, we see the time of the trade. That's when each trade was executed. It's important to note, by the way, all the trades we're going to talk about occurred at the same time. It's most likely the same individual or the same entity that made all these purchases. We have the options contract. This is the expiration. That's when these contracts expire. And it's important to note that, well, the options we're going to talk about, they all expire in May. So whoever purchased these contracts, well, they expect something to happen between now and May. Now, we also have the strike price. We're going to tell you exactly what the strike price is in just a moment. We have C for calls and P for puts. Calls are stock options you purchase if you think the market's going to go up. P or puts indicate that you buy that if you think the market's going to go down. Now, we also have the quantity. That's a number of contracts that were traded. And we have the execution price, how much they purchased, how much they bought, they paid for each one of these contracts. We have the delta. Well, we're going to tell you just in a second what that is. And we have the market spread. That's the bid offer or the buying selling price. It's important to know why. Here's why. A buy trade occurs when the execution price is closer, a little bit below, at, or a little bit above the offer price. In this case, the trade was executed at 55 cents, and at that time, the market was 47 by 52. So it's obviously closer to the 52. It shows us it's a buy trade because a buyer had to reach up and they got the higher price. Conversely, in this particular trade, it went off at 102. Now, 102 is closer to the $1 bid price as opposed to the 106 offer or ask price. Now, what's a dollar value for each one of these trades? It's actually very easy to calculate. We have here the quantity, 39,974 contracts traded, and they traded at 55 cents each. And it's important to note that the options contract always is in increments of 100 shares. So very simply, you take 39,974 contracts times 55 cents times 100, and that leaves us with a net sum of nearly $2.2 million. That's how much they spent to buy this one particular options contract. Now, taking a look at just what we saw on the screen over here, we can imagine a massive dollar amount of VIX calls were purchased today, with the implication that the stocks are heading lower. Again, we buy calls when we think the market's going to go up. They bought calls on the VIX. And remember, when the VIX goes up, the stock market goes down. So they purchased VIX calls expecting the stock market to go down. Were the options bought or sold? Well, again, we see here the trade went off at 55 cents, and at the time the market was 47 by 52. Well, you can see, or what you're going to see in just a second, every one of these trades were a purchase. Take a look at this. 45 cents, that was the execution price, and at the time the market, the bid offer, the buy and sell price was 40 to 45. That was a buy. This trade went off at 39 cents when the market was 35 to 39. This was at 35 when the market was at 31 to 35. This trade was at 31 when the market was 28 to 31. Every single one of these was a buy trade. Now, these two contracts in white, that's a calendar spread. Now, we're not going to bore you with the details of this right now, but it is a bullish trade. In other words, this trade, and this is a combination of these two contracts together, the implication is they believe the VIX will go up. In other words, the stock market's going to go down. Now, here's a delta, and all the deltas are out of the money. Wait, what does this mean? Delta's out of the money. Well, this is the option delta. It's a measurement of the option contract. Now, let's take the average stock. It's $50 a share. Now, we have something called an out of the money option. An out of the money option is when the strike price at which you can execute, the option contract is higher than the stock price. And when that occurs, the delta is very low, like 25. On the other side, we have option contracts that are in the money. An in the money option contract occurs when the strike price is less than the stock price. In that case, the delta is 75. So the purchases of the options with a low delta, such as less than 50, well, that implies we expect the stock to move higher. Doesn't make sense? We'll show you in a different way. Let's pretend another average stock that's $30 a share. Well, wherever the stock market is right now, that is a 50 delta. The current stock price corresponds with an option contract that is always 50. 50 means where the market is right now. And you'll notice as a stock price goes up from 30 to 35, 40, 45, the deltas go down. The higher out of the money, the higher the strike price is above the current market, the lower the delta goes. Conversely, when we go down in stock price, let's say the stock is at 30 and we look at the option contracts that are below the current market, the deltas go up. In other words, the deltas move opposite to the value of the stock or the option contract. So when we take a look at the deltas on the option contracts traded today, they're all very low. In other words, they're all out of the money. They're all purchased with the expectation the VIX is going to go up. Now, the largest VIX option transactions today, that's what we see here. And notice the ones designated with a P, those are puts. Again, a put contract is something you buy if you think the VIX is going to go down. Well, the yellow arrows indicate which contracts are puts. Conversely, the calls, a great deal many more contracts or calls were purchased today expecting the VIX to go up. Great deal more calls and puts today. And by the way, all executing on huge volume. It certainly shows a bias. Now, today's VIX option statistics, and again, I know at the surface this looks very complicated. It's very simple. We're going to point out just a couple important points here. We have here the calls and the puts. Now, we see here the calls traded. Well, there was 1.1 million calls traded. Again, you buy a call option if you think the stock's going to go up, the VIX is going to go up. There were only 225,000 puts that were purchased or put contracts. We have those contracts that traded at or above the ask. Remember, when the bid ask, the buy and sell price, when it's executed, the actual trade price is closer to the higher level, that means it's a buy. Well, the calls are 334,000 versus the puts of only 24,000. That means a great deal many more purchases of contracts. Well, they were buying call options, not put options. And then finally, we have the option deltas. Deep out of the money, meaning that they're buying call options with strike prices much higher than where the VIX is now. The VIX right now is around 19. They might be buying 25s or 30s or 35s, even higher. Well, 50% of the call options purchased today were deep out of the money versus 42% of the puts that were deep out of the money. In other words, all three of these metrics indicate there was a far greater deal of calls that were purchased. We definitely know they were purchase executions, not sales, and they were purchased well above the market, expecting the VIX to go higher. And by the way, remember, the expiration for all of these options, May. So whoever purchased these options, they're expecting something to happen between now and May. Now, here's some historical perspective for the VIX. This goes back about the past year or so. And we can see every yellow line shows us a spike in the VIX. Today, the VIX closed around 21. So far, the VIX activity itself, it's not really that unusual. We haven't hit any historic levels. It has had a pop up in the past couple days, but from a historical perspective, it's not really anything big. But the option activity is reason for concern. Oftentimes, the options market will kind of give us a hint as far as what's about to happen to that stock markets. Now, this is what we don't know. We don't know if the options purchased today are a hedge against the stock position. Maybe somebody bought the S&P 500 index or individual stocks and they wanted to buy a little insurance. Well, that's how you would do it. Maybe buy some VIX calls. So if the stock market goes down and your stock investment goes down, the call options go up. That's certainly a possibility. Were the purchases of the VIX calls, were they closing a short trade? You can short, sell short a stock in the same way you can sell short an option. Well, maybe they're just closing the trades. Maybe they're just, taking profits. Is this part of a portfolio management adjustment or another complex strategy? Well, we don't know. At the end of the day, we really don't know the reason why these trades took place, just the same way we don't know if somebody just buys 100 shares of Amazon stock. So we can only speculate. So why is all this so important? Because information is power. Now, we don't know at the end of the day the reason why these particular trades went off, although they are very unusual. But we try to collect data from many different sources, and the more data we have, the more armed we are as far as making intelligent decisions in the stock market. So let us know. Is this interesting? Would you like to hear more about this? We don't really talk a lot about this, and I know it's kind of a complex subject over here, so we don't tackle it very often. But let us know if you find any interest in this. We hope this has been helpful. We look forward to seeing you back soon.